Hello, friends. Welcome back to the Financial Freedom Show with Chase Lawson, where I, Chase Lawson, personal finance enthusiast and author of Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth, bring you a different personal finance topic each week with the goal of making it simple to understand. If you're just now tuning in, be sure to subscribe so you don't miss any great content. On today's episode, I'm bringing back a guest of mine who appeared on an earlier episode. Today, Zach Roberts, owner of Application-Based Learning, is joining us to discuss marginal taxes and how income tax works in America. If you missed our prior episode we did together, where we covered debt payoff strategies, be sure to check that out afterwards, as it's gotten some great feedback. But before we begin, Zach, do you mind introducing yourself again to those who are just now finding this show?
For sure. So thanks, first of all, for having me on again. I had an absolute blast last time, and a lot of my following really enjoyed the video. My name is Zach Roberts. I own a life skill-based education company that also specializes in customer service and customer support. I've been a personal finance obsessor, and our company has over 600 students enrolled in our 7-unit personal finance course. I'm pumped to talk about marginal taxes today, one of the most misconstrued of the personal finance topics, and one that has been in the current news lately, which is always fun.
Awesome. Well, thanks for that intro, Zach, and thanks for joining me again. And, as mentioned, today we're discussing income taxes, which can be quite confusing and complicated. In fact, if you look at the Internal Revenue Code, which contains the official legally binding tax rules that have been set forth by Congress, this is about 2,600 pages long. So certainly more than your usual bedtime reading. And while some might say that taxation is theft, as Benjamin Franklin once wrote, that in this world, nothing can be said to be certain except death and taxes. So we're all subject to taxes on our income, but it can be hard to understand how much exactly goes towards taxes. After all, unlike property and sales taxes, income tax is not a flat tax, though it would make things a lot simpler if they were, and many have tried to make a case for them to be so. And there are countless tax deductions and credits that can help reduce taxable income, which ultimately lowers the amount of taxes one is responsible for. Zach, I know you mentioned to me you've gotten a lot of questions about this subject. Is that right?
For sure. So many questions and a ton of common misconceptions. For example, people often get confused when they go up in a tax bracket and they try to do the math on their own, and then they end up nowhere near where they thought it would be. Like you said, it's not a flat rate, meaning that only a certain portion of your income is taxed higher when you go up a bracket, not the entire income. For example, in the current system, once you make more than about $85,500, you move up to a 24% income tax from the 22% income tax. That doesn't mean your entire income is now taxed at that rate, just every cent that you make between $85,500 approximately and the next bracket.
Awesome. Well, why do you think people struggle to understand how income taxes work in America?
For a couple main reasons. So first, in general, from what I've found, human beings don't really prioritize finance in their daily lives. They get the money they get and they spend the money they spend. Second, it's super complex. You have local, state, and federal income taxes. You also have that code changing depending on who is in office every 2 to 6-ish years. The third reason why people struggle is for some odd reason it isn't taught in the general education curriculum. Less than half of the states actually require a personal finance credit to graduate, and of those 21 states that do, only 6 or 7 require an actual finance class that's standalone, rather than just a unit in a different class. We live in a free market economy. Why doesn't every single person learn the basics of personal finance in school? Chase, can you tell this is my pet peeve?
Definitely. And no, I agree. I mean, the main reason I do this show is just to try and help others out where I can. I mean, I think if you have knowledge on such a critical foundational subject like this, you should definitely share that with others. So I like that we both have similar missions in that aspect. As my friend Ty and I discussed in the episode 5 Lessons Learned for Managing $1 billion, tax brackets have changed recently with the Tax Cuts and Jobs Act of 2017, which has helped many save considerably on their taxes each year. This act offered a massive overhaul of the tax code, including reducing tax rates within most tax brackets, as well as almost doubling the standard deduction, both of which have helped most taxpayers save on their taxes. For example, in 2018, for a single tax filer using the standard deduction, their taxes owed would have been reduced by 33% for someone earning $50,000 a year, 19% for someone earning $100,000 a year, and 11% for someone earning $200,000 a year. But when we talk about income taxes, you'll probably hear the term tax bracket thrown around. Zach, do you want to dive into what exactly tax brackets are?
For sure. Since this is a complex topic, I'm going to keep this one nice and short and sweet. So a tax bracket is simply a range of incomes that are taxed at a certain rate.
Right, and these tax brackets change based on filing status, right?
For sure. So you're either going to file your taxes as a single person or a married person. If you are single and filing your taxes all by yourself, you are in the single status. If you are married, you could file married filing jointly if you file your taxes with your spouse, or married filing separately. If you each file your own taxes individually, and each filing status has its own rules, benefits, and drawbacks, as well as how much income falls within each of the different tax brackets.
Okay, great. Well, if I look at the 2020 tax brackets, let's say I'm single and making $50,000 a year. Looking at the tax tables, I see that I'm in the 22% tax bracket. So, Zach, am I responsible for 22% taxes on the $50,000, which would be $11,000? Is that how that works, Zach?
Luckily for you, it's not. So this is the number one misconception that I see with students in my personal finance course and external classes that I teach locally. So in the current system, when filing your taxes single, your first approximately $9,875 in income will be taxed at 10%. Then your income from $9,875 to $40,125 is going to be taxed at a 12% rate. Then your income from $40,126 to $50,000 will be taxed at a rate of 22%. Does that make sense? Because it's a marginal tax system, only certain portions of your income are taxed at certain rates, not the entire income.
Okay, I got it. Yeah, that is pretty confusing. So Zach, I'm going to put on the screen for our viewers a simple tax table they can reference, as well as a link in the description that they can access and use for their own individual situation. But mind doing the math real quick to show what my taxes would actually be if taxable income was $50,000?
For sure. And this is an awesome table for the viewers to see. It's something that I find myself and my fiance often looking at just to make sure we understand where we're at. So first, you're going to find and mark on the table where your income is at in terms of which bracket your total income ends in. For this example, we're using a taxable income of $50,000. So just like this table shows, your first $9,875 of income is going to be taxed at 10% for a total of $987.50. Then your income from $9,875 to $40,125 is going to be taxed at a 12% rate for a total of approximately $3,630. And then your income from $40,125 up to $50,000 will be taxed at a rate of 22% for a total of approximately $2,172. This would mean your total income tax due would be about $6,790, which is significantly less than the misconception of paying 22% on the entire $50,000 for a total of $11,000. This is only an effective tax rate of 13.58% instead of that 22% that a lot of people fall into the trap of believing.
Awesome. Well, and thanks for walking through that, Zach. See, income taxes in America are considered progressive, with total federal tax burdens being a larger percentage of income for higher income households than for lower income households. The tax rate increases as more taxable income is earned. So going back to that example Zach just walked through, the first $9,875 of income for a single filer is taxed at 10%. If you make more than that, the next $30,250, which brings total cumulative income up to $40,125, is taxed at 12%. That's why you see the total tax due is $987.50 plus 12% of the amount over $9,875. That $987.50 number is coming from the fact that the first $9,875 is taxed at 10%, since 10% of that number is $987.50. With taxable income of $40,125, total taxes due becomes $4,617.50, since the first $9,875 is taxed at 10%, and the next $30,250 is taxed at 12%, which is why for the next tax bracket, you see tax due is $4,617.50 plus 22% of the amount over $40,125 and so on. Each filing status has its own tax brackets with different income amounts falling into the different tax rates, with the highest earners currently responsible for 37% of taxes on income that falls into the highest tax bracket. So understand that with income tax in America, you're not taxed at the same rate for all of your income. Your income ultimately falls into separate buckets that are each taxed at their own separate rate. However, not all of your money is taxed. As I mentioned previously, there are various deductions and credits that can help offset some of your tax burden. In fact, with the new guidelines from the Tax Cuts and Jobs Act, the Urban Brookings Tax Policy Center estimates that approximately 90% of households will take the standard deduction rather than itemizing their deductions. Zach, can you explain what the standard deduction is and how it works?
In basic terms, tax deductions allow individuals and companies alike to subtract certain expenses from their taxable income, reducing their total tax bill. You can either save receipts and proof, add all of these allowable expenses up, and submit them to the IRS, or you can deduct a flat amount known as the standard deduction. This standard deduction makes sure that everyone has some income that is not subject to federal income tax.
And some people may choose to itemize their deductions instead. So why might some people do that? What are some examples of ways that that can benefit someone?
So like I mentioned before, if you feel that your deductions should be higher than the standard deduction, you may decide to stay extremely organized throughout the year and submit your itemized deductions. It's a good idea every couple of years to run the numbers and compare. Resources like TurboTax will help you walk through this. As a business owner myself, I can't stress how important this is. If you go this itemized route to stay organized and keep every receipt and paper on file for the year and save them in case of audits. So when the year ends, don't just toss them all away. You always want to prepare as if you're going to be audited. So if it happens, you're prepared. Just a few of the many reasons why someone may choose to itemize to increase their deductions and lower their tax bill include if you have a large charitable donation, maybe you have mortgage interest and property taxes, maybe you had some out-of-pocket medical expenses, or maybe there was some uninsured theft, casualty or natural disaster costs, investment interest, and much, much more. Again, every couple years, just run the numbers of your costs of these itemized deductions and see if they would be higher than the much easier to compute standard deduction.
Yeah, I definitely agree with that, Zach. Fortunately, I've been able to itemize my deductions the last few years, which has helped me save even more on my taxes. And the government does understand that everyone has some of these expenses they're responsible for. So they created the standard deduction to essentially give everyone more of a level playing field and to make it easier and simple for a lot of people to not have to necessarily worry about keeping track of all their expenses that could qualify as itemized deductions if they want to just take the standard deduction. But to your point, definitely run the numbers to see what makes sense. TurboTax and other tax softwares make this a really simple process. But going back to our example from before, if I'm paid $50,000 a year before taxes and I'm single and use a standard deduction, which is currently $12,400, my taxable income, barring any other deductions, is only $37,600, meaning my tax liability will be $4,314.50, which based on $50,000 of income is now only an effective tax rate of 8.63% instead of 13.58%, saving you about 5% in taxes. In addition to itemized deductions, there are other tax credits and deductions that could help reduce your tax liability. The difference between tax credits and tax deductions are that credits reduce your taxes dollar for dollar, whereas deductions reduce your taxable income, which then gets taxed at whatever rate applies based on your tax bracket. So for example, if you owed $10,000 in taxes, having $1,000 in tax credits would reduce that amount dollar for dollar, thus bringing your tax liability down to $9,000, while $1,000 in tax deductions would likely only shave off $220 or $240 in this scenario, since deductions are reduced from income before calculating your taxes, while credits reduce tax liability after calculating your taxes. It is through these tax credits and deductions that people are legally allowed to lower their taxes. This is known as tax avoidance, which is 100% legal as long as you don't claim deductions and credits that you are not allowed to, whereas tax evasion is illegally not paying taxes you owe. The most common tax credits include the Earned Income Tax Credit, American Opportunity Tax Credit, Lifetime Learning Credit, Child Independent Care Credit, and the Savers Tax Credit, whereas the most common tax deductions include, what Zach mentioned before, such as student loan interest, charitable donations, medical expenses, state and local taxes, mortgage interest, traditional IRA or 401k contributions, HSA contributions, educator expenses, and more. Zach, I often hear people advise to be cautious, though, when it comes to bonuses or raises, as these may push someone into a higher tax bracket. What are your thoughts on that idea?
For me, I say never be cautious with increasing your income. If someone wants to give you more income, take it. Sure, that bonus could be a part of your income and put you into that higher tax bracket, or you could take that bonus and you could put it into something like a health savings account or put it in a qualified retirement savings account to reduce your taxable income. Another popular option is a deferred compensation plan you can set up with your usually very motivated to do so employer to spread out that bonus over a larger period of time. In my eyes, it would be silly to be cautious with the bonuses or raises. Most people have a tax professional or a robo-tax professional that would know just what to do if this happens.
Yeah, and I definitely agree with that, Zach. I think it's foolish to avoid a bonus or a raise just on the fact that it could put you in a higher tax bracket. After all, say you're at the top of the 22% tax bracket currently, and your employer offers you a $10,000 raise, all of which would then fall into the next tax bracket of 24%. In this case, you would owe an extra $2,400 in taxes, but you'd still take home an extra $7,600 per year, which will only continue to add up and compound upon itself. Once again, only the portion that falls into that next tax bracket is taxed at that higher rate, not the full amount of your income. Zach, is there anything else that you wanted to discuss around taxes?
Yeah, so as a business owner and personal finance obsessor, I cannot stress enough the importance of educating yourself first by watching videos just like this one and using a tax professional as well. In my experience, using a tax professional has paid for itself every single time. Not only does it protect me from error, but it saves me money that is needed by almost every single household in America. And most of the time, you'll pay the tax professional out of your tax return, so you won't really have any upfront costs. Lastly, don't forget to look into cool tax-advantaged accounts such as HSA accounts for health and Roth IRAs for retirement savings. And I know Chase has a recent video that helped my students a ton.
Awesome. Yeah, those are great ways to help avoid taxes. And once again, for those who haven't yet seen our other episode that we did together, which they should definitely go and check out afterwards, but how can our listeners find you if they want to learn more about you and application-based learning?
You can find me on Instagram. My personal page is @TeacherZach. It's actually a brand new Instagram page, so come check it out and show some support. My business, which teaches life skill-based online courses and runs customer service and social media for large and small businesses and e-commerce businesses, can be found at Application-Based Learning on both Facebook and Instagram. And never be afraid to reach out to me.
Perfect. Excited to check that out, Zach. And Zach, thanks again for joining us today. This was great. And to those just listening, I hope you got some value out of this episode. Taxes can be confusing, but just know that income tax is progressive. Not all of your income is taxed at your highest rate, and you can effectively utilize tax credits and deductions to reduce your tax liability. Thanks again to everyone for tuning in. And as always, please be sure to like this episode or leave a review if you got value out of it. And if you have not yet subscribed, be sure to do so you can stay up to date every time a new episode comes out, and be sure to share this with others. Finally, I would love to hear your thoughts and feedback, so let me know what you think of it, or if there's any other topics that I can cover for you. Thanks so much, stay safe, and go get them.